Well, today we're going to be talking about an auto ancillary company, and why this one is interesting at a juncture like this is because we are starting to see raw material costs inch up within the auto industry as a whole, and we'll get a sense as to how much of that is being absorbed at what point in the value chain. So that's one of the interesting pieces. The other one is within this auto ecosystem or auto ank ecosystem, Sandhar Tech is uniquely placed because some of its competitors in the same similar product kind of space are valued at 2 times the multiple that Sandhar is valued at. And therefore, this one looks interesting. So those are the two factors which we'll keep our eye out on. But outside of that, very strong growth is what is being penciled in. The EV ramp up in terms of the EV in the auto ank space, the EV ramp up within Sandhar is something that we'll watch out for. And also with regard to how margins evolve, also a large part of the CapEx seems to be behind them. So now it's all about execution over the next 2 to 3 years. They're looking to double revenue over the next 3 to 4 years, and therefore we'll try and understand as to what the glide path for this looks like. But a very solid returns is what it's already posted over the last 12 months or thereabouts. Now let's try and contextualize this a little better, take a bit of a step back, look at what the company has done over the years. It was incorporated in 1987, largely into locking systems. That's how they started off. Very heavy penetration is what they did with regard to locking systems, especially in the two-wheeler basket. It's a promoter-driven company, obviously, and 70% promoter ownership. You will look at shareholding as well. It operates in the auto ank, off-highway vehicle component space as well, is something that they have gotten into. Market cap currently at 4,200 crore for this one. Now, let me take you through the product suite. In terms of the die castings, that's the first product, and we'll give you a lowdown with regard to the revenue mix as well, product-wise. But there's aluminium, there's zinc, there's magnesium. Currently, die castings, which go into critical components within within a vehicle, are largely have been steel. But steel is extremely heavy, right, as a metal, and therefore we've started to go in terms of more lightweight, given the Indian context that your average of the car or kitna deti hai improves, and aluminium is 3 times less in terms of the weight, and therefore aluminium is one big play with regard to utilizations within a vehicle. Thereafter, there's zinc. Zinc provides for a better finish to the vehicle, and therefore zinc is the other play, but it's only for the finishing components where zinc is utilized, because zinc is heavier than aluminium but lighter than steel, and it allows that a slightly better finish to the vehicle, and therefore zinc is used there. Magnesium is 35% lighter than aluminium as well, and therefore magnesium die castings are also products which auto companies have been focusing on, and Sandhar does all three, which is aluminium, zinc as well as magnesium die castings. So this entire new age kind of ramp up will be something that Sandhar actually benefits from. In terms of mechanical locking systems, and this is something Sandhar has done right from the start. So since 1987, this is something that they have really mastered. They have not just a moat, but a possible fortress with regard to locking systems, especially in the two-wheeler space. So door locks, steering locks, ignition locks, smart locks, difficult for auto companies to diversify outside of a company which they already work with, because designs as well as the manner of functioning of an entire vehicle very often depends on some of these locking systems. And therefore, Sandhar has a large moat with regard to this. Then there's vision systems, which they've diversified into. Rear view mirrors, now cameras, ADAS linked vision. Now this is higher up the value chain as well. So you're suddenly going into smart locks and cameras, and that has a much better price point, and it also has a much better margin in terms of the product margins. And therefore, they're going higher up the chain, and they're aiding those auto companies also to do that. So within the product suite, that also comes in. Then there's sheet metals, various, and in terms of the use case, it's used for body panels of vehicles, brackets, cross members, floor panels, structural reinforcements. All of that is taken care of by sheet metal products. This is just a diversification strategy. You start with auto and then you go into the, or rather, you start with locking systems and then you go in and penetrate the client on various other value-added products that the client requires, and you try and provide all of those to the client, and that's really the strategy here. Then you have polymer and plastic parts, dashboard components and the like, which are again the premium finish which is required has started to look much more attractive. So you've got dashboard components, and then within the EV space, you've got EV motor controllers, DC to DC converters, EV chargers. Let me actually take you through each of those. So a motor to motor controller only controls the quantum of power that flows between the battery to the vehicle. A DC to DC converter actually converts high voltage from the battery to low voltage into the vehicle. And then you have the EV charger itself, which also is something that Sandhar looks at. So you've got all of these in terms of products. Now let me switch and give you a sense of the model, and maybe I've touched upon it a little bit as well. So they build relationships with auto manufacturers. They started manufacturing locking systems in '87, and two-wheeler locking systems business is something like a fortress of sorts. You've got critical starting relationships through this particular component. Thereafter, you start supplying other components. Higher margin, especially in new age locking systems, is something they're seeing. They're starting to increase wallet share per customer. A top 10 customers provide a large chunk of the revenue, so that's one of the risks as well that you want to look out for. And more volume now is what they focus on rather than value, but they're starting to look at value as well in terms of the proposition. Customers, and you'll see some marquee names out there: Bajaj, Hero, Honda, TVS, Maruti. You've also got JCB, Case New Holland, Escorts, Mahindra Tractors. They also make the cabins for some of the JCBs that you see, or the off-highway vehicles that you see. The cabins are built, and thereafter the OEM fits the cabin onto the vehicle. So some very interesting pieces which Sandhar does in terms of its business. Now, in terms of product mix, and I did tell you I'll give you that, in terms of this is how the shift has been, FY25 versus FY26. Just 1 year, you'll see a sharp rise in the die casting business. Locking systems also, you've seen a slight bit of a taper down, but growth has been there. Cabins and fabrication has been a taper down. When you're looking at sheet metal, but that's a large part because of the way in which aluminium die castings has moved up in terms of the revenue mix. But that's broadly the way in which revenue mix has moved. Vision systems has been largely flat. 26% growth is what it's clocked on its top line for FY26. Let's look at category-wise sales as well. And you'll see that two-wheelers, you've seen a ramp up with regard to sales. PV also has lost some of the share in terms of revenue. Off-highway vehicles has lost some of the share, and others has ramped up as well. So broadly, this is the way in which it's played out. Geography, 90% has been the India geography that it caters to. Approximately 10% is rest of the world. This is a ballpark number. We'll await the annual report to get the exact number. India versus rest of the world. Let's look at the financials now. And in terms of the financials, you've seen very decent growth. Last 3 years, you've seen a 19% CAGR on the top line. They promised to double revenue from here over the next 4 years as well. So broadly, this is the clip that you're looking at in terms of revenue growth. EBITDA has grown at 21%, so margins have gotten marginally better, even though this year margins have come in slightly lower. We'll come to margins in just a bit. Profit is up 39% in terms of the CAGR. So you've seen a very sharp growth in terms of profitability. Let me now talk a little bit about the margin trajectory, and the margins have been between the 8 to 9% range. We've seen a bit of a sink on the margins versus FY24 and 25. Also, the scale up and the ramp up has what has led to that. What we're seeing in terms of the balance sheet is around a 1,300 crore rupee book value on cumulative book value, and you've got a 4,200 crore market cap. So approximately 3 times is what it trades at in terms of price to book. You've got a 950 crore borrowing number, both short-term as well as long-term, excluding lease liabilities, and a cash bank balance of around 50 crore. The net debt currently sits at roughly 700 to 750 crore, and therefore that neutral stance with regard to the balance sheet. That debt needs to come off, but a large part of the CapEx is largely done. We'll quiz management on how this plays out going forward. Let's talk about cash flow now. Cash flow has been weighed down upon because of inventory build-up, because of build-up in terms of raw materials. Those are the two places where there has been a build-up, due to which your cash flow from operations hasn't come through as much as one would expect. In fact, cash flow from operations actually tapered off between FY24 to 26. So that's one other focus area which we will have our eye out on. In terms of return ratios have inched upwards rather smoothly. In fact, ROEs are above the 17% number, at least at this point. But ROC, that number is currently standing at 14%. More required to be done, and I'm sure that as the scale-up happens, you will likely see that happen. For the moment, conservative, neutral on this one as well. Shareholding pattern, you've got 70% ownership from the promoter, so no concerns at all there. There's some bit of FI ownership. DI is also participating healthily, around 800 crore of holding that DIs have at fair market value. And then you've got the public, which holds approximately 12% odd. Analysts super bullish on this one. You've got 6 analysts with a buy call, no holds, no sells. 22% upside is what the analyst rating is. Let's pull up the analyst rating before the valuations. There you go. That's how it stacks up. In terms of the valuations, your 1-year forward PE currently trades at 19 times 1-year forward. Mind you, some of the others trade at far higher valuations, maybe 1.5x of this broadly, or even higher than that. Your 5-year average, and Minda Corp is one of those. You know, Minda Corp is a direct competitor to Sandhar. 15,000 crore in terms of market cap, so 3x the size, maybe 4x the size nearly. You've got the 5-year average that Sandhar has traded at is approximately 15 times 1-year forward, and the 5-year range is between 7 and 25 times. So it trades at a slightly higher end of the band, but decent growth is what is being penciled in. Even the EV to EBITDA, when you're looking at it, very similar trend. So broadly, this is how the numbers stack up in terms of valuations. Let me bring on board Jayant Davar. He is the chairman and CEO at Sandhar Tech here to give us a perspective on how to look at the business going forward. Mr. Davar, it's been a fantastic year for you. The growth has come through, but plenty of headwinds likely at the start of FY27 already is what we are seeing. What's the impact, tell us, of West Asia, for example? Metal prices are high, aluminium prices have risen. What's the likely impact on your business of that? Die castings is a large part of your business.
Yes, thank you very much for having me.
Great having you.
Broadly, the Middle East tensions meant that the first impact was that about unavailability of gas, very high costs on aluminium alloys, on any other commodities, whether it was plastic. But the worst thing that hit us was the unavailability of manpower. That wasn't so much West Asia, that was more in terms of our internal elections and Holi and so on and so forth. This particular year has been a major constraint in terms of manpower. See, demand is extremely high at this time. I have never seen demand at the levels that I am seeing today. And it is now for the entire industry, not just Sandhar, to be able to service that. And in servicing the servicing of that, unavailability of manpower still stays a constraint. In terms of costs, obviously the costs for commodities as well as for all other aspects, including manpower costs, because you've seen a lot of states declare their minimum wages to go up drastically. Not just in terms of 20%, 30%, but in the case of the new thing that I read about Karnataka, almost 60%, which are unlikely to go back. Even commodities may not go back to the levels that we were seeing earlier. According to me, this means that there is going to be a pricing retrigger, and these will obviously be passed on to the OEMs, which mean that either the OEMs will somehow absorb these, or the prices of vehicles themselves will go up. But for us in the industry, most of this is passed through. It is a temporary lag of 3 months while new negotiations are being done. But once having been done for the entire year, I don't think this will have an impact in terms of our working or our results. But yes, how it affects the entire sector in terms of pricing, retriggering, like I said, we'll have to wait and see.
Right. So that is yet to be passed through. Is that what you're saying, Mr. Davar, or you're confident that it will pass through?
A part of it is passed on. But okay, like I said, see, every time there is a pass through, it's normally that of commodity. which have a 3-month lag. But this particular time, because every input has gone up. When I say input, a lot of them could be oil based, a lot of them could be manpower based, a lot of them could be directly commodity based, which otherwise, being small inputs into the system, are not really reflected in every pricing mechanism that happens. This time, the entire costing mechanism itself is going to be re-triggered and repriced.
I'm really liking the candid nature of this. So you're telling me that pretty much all inputs will go up, but metals will likely get passed through in terms of cost component. Maybe polymer as well, to some extent, might get passed through. You make dashboards and the like. Maybe manpower, you may not be able to pass that through.
No, I'm not saying that at all. I am saying everything will be passed on. It will have to be passed.
Perfect. Understood. Okay, got it. And therefore, you'll be able to maintain the 9% plus kind of margin number for FY27 as well, and maybe 4%
I
PAT
would
margin?
think so. Well, the effective margin on our business should ideally be 12%, but because we are a growing company, and every year we have several projects which are new and which are in the pipeline. If you look at our new projects that are currently on, we made new investments in the past year for about 342 crores, out of which revenue is still at a generating level. We just went up to 468. Typically, our asset terms are 3 times. If I was to look at it and remove those particular instances, our margins, if you look at India business, for example, is almost close to 11% in any case. So, and in any case, we've given a guidance of 25 to 50 basis points improvement every year. We've been able to do that throughout, and we should be able to do that even going forward.
So a 50 basis point improvement likely on the margins, despite
Yes.
the Q1 being slightly softer. Is that the right way to think of FY27?
Yes. What you've shown today is slightly different. My numbers show up that our EBITDA is up 33% from last year, which is at 11%. PBT is up 42%. Even on a consolidated quarterly performance, we are at 10.6%, not 9% that you're showing. So actually, our EBITDA has gone up from the previous year to where we are this year.
I'll factor that. And
Yes.
the 4% PAT margin, is there scope for expansion there as well by maybe
Yes,
40
that
odd
will
basis points?
automatically go up. That will
Correct.
automatically go up. If you
Correct.
look at our EBITDA, this particular year is 513 crores, and our PAT margin is 4.1%. Again, it's been going up every year on year. In 21, 22, we were at 2.4%, then 2.5, 3.1, 3.6, 4.1. So we've got a 50 basis point improvement over last year, even in the PAT margin. We see no reason why this should not continue to grow.
Understood. The CV cycle, sir. Could
Yes.
there be an impact there, just given the disproportionate pricing impact that will be seen over there? Do you believe that two-wheeler, just take a step back, do you believe the impact on two-wheeler, PV, CV will largely be uniform, or will CV be worse off in this uptick with regard to metal prices?
Well, if you ask me, I think the country is doing well. Like I said, the demand right now from every sector is at levels that I have not seen before. The only area where we got a little bit of setback in the country was in the construction equipment last year. That was on account of the pollution norm change that affected that. But I see that demand there has come back again, and we are positive about that particular sector as well. But in terms of CVs, passenger vehicles, two-wheelers, the demand that I see is quite overwhelming.
Okay, so that looks to be sustaining, and you have a disproportionate revenue coming from two-wheelers. You're looking to switch from that? Would you look to diversify a little bit more, or that'll take some time?
Honestly, we don't have a strategy towards which segment to play. We play wherever we get opportunity. Last year, we obviously added a little more to the two-wheeler front because of our acquisition of the Sundaram Clayton die casting business in Hosur. And obviously because that was supplying to two-wheelers. Similarly, we did some acquisition in the machining business and some in the sheet metal business. So, and that was largely frames for the two-wheelers. But going forward, as always, wherever there is opportunity, we we jump in. Uh, Going forward, I do see the passenger vehicles portion starting to get a little higher in terms of percentage of output on account of some new opportunities or some new things which are already developed, which will go into the market in this particular year. Yeah, this will be a dynamic movement. We are not focusing towards one, but just focusing towards wherever we get good opportunities.
How much would that be, sir? Just in terms of opportunity or the size or the revenue that you're looking at? You look at a revenue of roughly 6,000 crore next year is my guess. How much would PV be if at all you were to put a number to it?
Well, I would imagine it would be slightly higher than where we are today, because for this particular year, it would be higher for sure. But obviously, when you're looking at a growth which is similar to what we've done this year in terms of percentage, some of the new things that we had taken on, I did mention Sundaram Clayton and some sheet metal business. They will obviously mature. There are some new plants which have gone active and will be going active in the next 2 months, which will generate more two-wheeler business as well. But at the same time, with the opportunities in the four-wheeler that I spoke about, those will go online. It's difficult for me to exact numbers, except to say that you would see PVs slightly higher than where they are right now in terms of percentage.
Okay, for viewer context, they do 16% from PV at least at this point in terms of revenue mix. So slightly higher over there. In terms of margin accretive business, that has been one of the other, calling points for you. EVs, smart locking systems, cameras, and the like. How much better are the margins there, and how much does that really add to your margin? And how much does operating efficiency add to your margin? If you can give us some perspective.
Well, smart locks, you mentioned, and other electronics. The value there is much higher. So a value of a smart lock is typically almost 10 times as much as a manual or a mechanical lock. And in that particular case, the volume of profit obviously is higher. The margins are slightly higher in terms of maybe 50 to 100 basis points. But because each smart lock represents a typical 10 times of value in terms of mechanical locks, that volume goes up dramatically. Having said that, smart locks really haven't picked up the way we had anticipated. So in terms of numbers, we did 70,000 locks, smart lock sets last year. We will probably have that number go up, but 2 times more this year. It's slow in the take, but yes, absolutely, in terms of volume of profit, that is very, very accretive.
And what's the new product pipeline really looking like? You suggested that PV would be one of the places where a couple of
Yes,
new
and
products would
PVs,
probably help you.
yeah,
Please.
PVs, for example, we have the new inside rear view mirrors. These are self-deflecting mirrors, which are again 10 times in terms of value of a regular mirror. These will be launched off now in the next 2 months. And effectively, we feel that they will become a standard across the industry, which should be highly accredited to us. So that again is something which will add to the percentage of our product mix towards PVs.
Your guidance seems to suggest that you suggested 15% plus growth for FY27. Are you being
Yes.
conservative because higher value product is what you seem to be trying to get to, and
Yes.
therefore should 20-25% be the bare minimum that one should expect?
See, at this point of time, there is a lot of uncertainty in the market. When I say uncertainty, I'm not saying in terms of current demand, but with whatever is happening globally in terms of whether it's the Middle East tensions, whether how the commodities are going to play out. In the month of April, the two-wheeler industry in India lost about 2 to 300,000 vehicles not being produced. If that was to happen on a more periodic level or for a few other months during the year, I think that would have an impact on the entire industry. So we will have to wait and see. So we've kept it conservative, very, very conservative for that matter. You're right. We also haven't taken into account revenue increase, which will come in through the price retriggering that I spoke about. So there is definitely a scenario where you will see that new negotiations will happen, which will lead to the entire industry uptaking their revenues. You call it inflation, you call it desperate times, but with all the new aspects of cost increases, that will lead to further revenue. We haven't taken any of that into proportion. All we are saying is we've taken it very conservatively, that in the worst case scenarios, this is what the entire thing looks like.
Right. And what happens with regard to the fresh capex that you've done? There's still some capex to go. FY27 and FY28 also you'll have a ramp up with regard to capacity. So one is supply side
Yes.
and one is demand side. You've spoken
Yes.
to us about demand side. What about supply? What happens in terms of asset turn? How quickly do you ramp those up, FY27, FY28?
Like I said, in the last year, we made an investment of 342 crores, which during the year, which was at different times of the year, we could manage a revenue of 468 crores with a negative EBITDA and 46 crores negative at the EBT front. We expect that this business will mature to a revenue which is typically about three times the investment, and with positive EBITDA and hopefully positive EBT in this year. So with the removal of the negative portion, I think it will generate the profit at the bottom line. In terms of new investments, again, you have to understand that we operate with 47 plants. With 47 plants, there is maintenance CapEx, there is incremental CapEx. And CapEx, when you do, doesn't really mature and become accretive in the same year. That's the reason why I said our margins on a mature basis should be around 12%. But we don't reach that level because we are a continuous growing company. And with the guidance that we are speaking about, and if we are going to double our revenue every 3.5 years, we need to keep that investment always on the flow.
Point taken. What happens to debt, sir? Very quickly. I'm really short on time. So what happens to debt?
Well, debt, we are not worried about debt. If you look at our debt, which is gross debt of about maybe 900 odd crores, if you look at it, I'm actually 550 crores out of that is working capital. And honestly, I'm very happy with working capital debt because that means that we are growing. So you would see that growing. Obviously, we've grown by 1,000 crores. There will be working capital which will obviously get involved. In terms of our term loan, which is about 350, we will repay. We have a schedule to repay 109 this year. We will continuously reduce debt. But even with new CapExes and so on and so forth, even if we have to borrow, that term loan debt will not go up. It will, in fact, keep reducing as we go forward.
So term loan debt comes off, working capital
Yeah.
stays as is. That's
Yeah.
broadly the
Stays
thing. Okay.
as is or possibly even grows, but I'm not worried about that. But that means we are
Sure.
growing faster. And therefore, obviously, those are working cycles.
And cash flow translation will happen better going forward because that's not happened last
I would
couple of years.
imagine so. I would imagine so. I think that would be a
Right.
natural outcome of this.
Absolutely. Thank you so much, Mr. Davar, for coming in and speaking to us.
Thank you.
This has been
Thank
a
you very
pleasure. And
much.
you've been super candid. So thank you for that.
Thank you very
Okay.
much. Bye-bye.
Thank you. And viewers, that's all the time we have on this edition of All About Your Company. Thanks so much for tuning in.